Alright, let's talk about Praj Industries. This isn't just some company name you skim over. Praj is a big player in the world of biofuels and process engineering. Think about ethanol plants, water treatment, all that critical stuff. They are involved in building solutions for a more sustainable future, which is something we all should be paying attention to, especially in this day and age. They operate globally, providing technology and engineering services. So, when we look at their money, we're looking at a company with a significant footprint in an important sector. It's essential to understand their financial backbone if you're even thinking about them. The reason we're diving deep into Praj's financials today is simple. You need to understand if this company is strong. Is it making smart money moves? Can it pay its bills? Is it growing? These are not just questions for big-shot investors. These are questions you should be asking. This analysis aims to cut through the noise and give you a clear picture of Praj Industries' financial health. We will look at their ability to cover short-term obligations, how profitable they are, how much debt they use, how efficiently they run their operations, and what the stock market thinks of them. Knowledge is power, especially when it comes to your money and the companies you might invest in. Now, let's talk about liquidity. This is a fancy word for a simple idea. Can Praj pay its immediate bills? We look at something called the current ratio. This compares their current assets, stuff they can turn into cash within a year, to their current liabilities, which are bills due within a year. Over the past few years, we've seen some shifts here. You want this number to be comfortably above 1. If it's too low, alarm bells should ring. It means they might struggle to pay their short-term debts. We need to see if Praj is keeping this number healthy and consistent. Then there's the quick ratio, also known as the acid test ratio. This is even stricter than the current ratio. It takes out inventory from the current assets because sometimes inventory isn't so easy to sell quickly. So, the quick ratio gives us an even tougher look at whether Praj can meet its short-term obligations without relying on selling off its stock of goods. We also look at the cash ratio, which is the most conservative of them all, focusing only on actual cash and cash equivalents against current liabilities. These ratios together tell a story about Praj's short-term financial stability. Are they standing on solid ground, or is it a bit shaky when it comes to immediate cash needs? This is crucial information. Okay, so Praj can hopefully pay its immediate bills. But is it actually making good money? That's where profitability ratios come in. First up is the gross profit margin. This tells us how much money Praj makes from its sales after subtracting the direct costs of producing its goods or services. A higher gross profit margin is better, obviously. It means the company is efficient in its production and has good pricing power. We need to examine if this margin has been growing, shrinking, or staying flat for Praj. This trend reveals a lot about their core operational strength and competitive position in the market. Next, we look at the operating profit margin. This goes a step further than the gross profit margin. It tells us how much profit Praj makes from its core business operations before interest and taxes are paid. So, it includes operating expenses like salaries, marketing, and rent. A healthy and improving operating profit margin suggests that the company is not only making money from its products, but also managing its everyday business expenses well. And finally, the net profit margin. This is the bottom line, people. It shows what percentage of revenue is left as pure profit after all expenses, including interest and taxes, have been deducted. This is the ultimate measure of profitability. Beyond just margins, we need to look at how well Praj is using its assets and equity to generate profits. That's where return on assets, ROA, and return on equity, ROE, come into play. ROA shows how efficiently Praj is using its total assets, things like machinery, buildings, and cash, to make a profit. A higher ROA means the company is sweating its assets harder, getting more bang for its buck. Return on equity, or ROE, is super important for shareholders. It measures how much profit the company generates with the money shareholders have invested. A consistently high ROE is often a sign of a strong company that can grow without needing a lot of new capital. Now, let's talk about debt. Debt isn't always bad, but too much of it can sink a company. The debt-to-equity ratio is a key leverage ratio we must examine. It compares the company's total debt to its total shareholder equity. A high ratio means the company is using a lot of debt to finance its assets, which can be risky, especially if interest rates rise or profits fall. We need to see if Praj is managing its debt levels responsibly. Another important leverage ratio is the interest coverage ratio. This tells us how easily Praj can pay the interest on its outstanding debt. A higher ratio is safer, meaning the company has plenty of earnings to cover its interest payments. A low ratio is a red flag. How well is Praj managing its day-to-day operations? This is where efficiency ratios give us crucial insights. Let's start with inventory turnover. This ratio shows how many times Praj sells and replaces its inventory over a specific period. A high inventory turnover is generally good. It means the company isn't tying up too much cash in products sitting on shelves. It suggests strong sales or efficient inventory management. However, if it's too high, it could mean they are losing out on sales due to insufficient stock. So we need to look for a healthy, consistent turnover rate that makes sense for their industry. Then there's Days Sales Outstanding, or DSO. This tells us the average number of days it takes Praj to collect payment from its customers after a sale has been made. A lower DSO is better. It means the company is getting its cash quickly, which improves cash flow. A higher rising DSO can be a warning sign. It might indicate problems with collecting payments, or that the company is offering overly generous credit terms to boost sales, which can strain its finances. We need to see if Praj is efficient in turning its receivables into cash, as this directly impacts its working capital and overall financial health. Combining these, we look at the cash conversion cycle, CCC. This measures how long it takes for Praj to convert its investments in inventory and other resources into cash from sales. Essentially, it's the time between paying for raw materials and receiving cash from customers. A shorter CCC is desirable because it means the company needs less time to finance its inventory and receivables, freeing up cash for other purposes. Analyzing the trend in Praj's CCC will tell us if their operational efficiency in managing working capital is improving or deteriorating. This is a critical measure of how well the business engine is running. Finally, let's see what the stock market thinks about Praj. We look at earnings per share, EPS. This is the portion of a company's profit allocated to each outstanding share of common stock. Growing EPS is generally a very positive sign for investors. Then there's the price-to-earnings, PE ratio. This compares the company's current share price to its earnings per share. A high PE ratio can mean that investors expect higher earnings growth in the future, or it could mean the stock is overvalued. We also consider the dividend payout ratio, which shows the percentage of earnings paid out to shareholders as dividends. This is important for income-seeking investors. So after looking at all these numbers, what's the overall financial health of Praj Industries? We've seen that understanding their liquidity, profitability, leverage, and efficiency is not just for the accountants, it's for you. The trends in these ratios give us a story. For example, if liquidity is strong and profitability is rising, that's a good sign. But if debt is creeping up while efficiency is falling, then you need to be cautious. Praj's strengths might lie in its innovative technology in the biofuel sector and its growing market presence. However, areas needing attention could include managing working capital more tightly or diversifying revenue streams further. Key strengths for Praj often revolve around its niche expertise in bioenergy and sustainable solutions, a sector with significant growth potential globally. They might have strong research and development capabilities leading to innovative products and processes. However, potential areas for improvement could involve optimizing their cash conversion cycle further. Perhaps their days sales outstanding are a bit higher than ideal, or inventory management could be even more streamlined. Addressing these areas can free up valuable cash, making the company even stronger and more resilient. It's about continuous improvement. No company is perfect. What can Praj do to get even better? First, optimizing working capital is key. This means looking closely at how quickly they collect cash from customers and how efficiently they manage their inventory. Strategies could include offering small discounts for early payment or implementing just-in-time inventory systems where appropriate. Improving the cash conversion cycle puts more cash in Praj's hands faster. This cash can then be used for growth, to pay down debt, or to return to shareholders. It's about making their money work harder for them every single day. For strategic recommendations, revenue diversification could be explored further. While being a leader in biofuels is great, relying too heavily on one segment can be risky. Exploring adjacent markets or new applications for their technology could provide more stable and diversified income streams. Furthermore, continuously focusing on improving operational cash flow is paramount. This involves not just cost control but also efficient project execution and contract management to ensure timely payments. A strong and predictable cash flow is the lifeblood of any successful company. Praj has a strong foundation, but smart strategic moves will define its future success and its value to you.